Tom White, co-host of Fast Market, is joining me now as we take a look. Gold's at 34.08. It's up about $1. A lot of action here on the floor of the New York Stock Exchange as we get that in, but not a surprise to leave the Fed rate unchanged, right?
No surprise at all, Nicole. Expectations for them to keep those steady. There were some red lines within the report here from the May meeting that I think are warranted at this point. The unemployment rate remains low. They took out the words that stated has stabilized at low levels in recent months. They also, uncertainty about the economic outlook has diminished but remains elevated. They took out the term increased further, and then they also took out, as far as the risk to both sides of its dual mandate, they wiped out the judges that the risks of higher unemployment and higher inflation have risen. I think that's really key. You're seeing a little bit of a sell-off here in yields, equities going, kind of consolidating right now. But I think more than anything, you're going to have to look at some of the commentary out of Fed Chair Powell moving forward. I think a lot of the discussion is going to be on jobs, the jobs market, because it feels like the mandate on the inflation side, the price stability is there despite the impact of tariffs moving forward. So we'll have to see from his commentary, but I think a lot of the focus is going to be on the jobs market.
Yeah, I mean, this is huge. First of all, the fact that the risks to the dual mandate have risen and they took that part of the language out certainly makes folks feel better. It means that they don't think inflation is going to soar, and it doesn't, and they don't think unemployment will soar. I mean, that makes me feel a little better, right?
Yeah, and I think that was the fear, that not only Fed Chair Powell during his commentary over the last couple of months, but a lot of the Fed presidents individually were stating that they were concerned that the tariffs are going to have a negative impact or a heightening impact on inflation, and that hasn't come to fruition at all. You wonder if he's going to walk back some of those commentaries if he gets any hardball of a question from the press, which he typically doesn't. But that's going to be, I think, one of the things he's going to have to address is that, hey, the tariff impact has not heightened inflationary fears moving forward. They've actually cooled the last three readings. So it'll be interesting to what he says about that. But as I mentioned, he's going to have to mention the jobs market. We're still at 4.2% unemployment rate. That's full employment at this point. We've seen some cracks, whether it's jobless claims or a decrease in non-farm payrolls. But is the economy taking care of the inflation side of their mandate where, hey, we've seen a pullback in consumer spending. Retail sales came in a little bit lighter than expected. GDP expectations have come down quite a bit due to the uncertainty of tariffs. So the consumers might have taken the impact of those inflationary fears that we were going to get an increase in inflation at this point. So we'll see how he addresses those two mandates.
I got to tell you, Tom, the one thing that I really am thinking about, do you remember not that long ago, Jay Powell and President Trump had a conversation. They didn't discuss monetary policy, where the rates should go, reportedly. But Trump, I guess, spent some time to try to explain how his tariffs would not bring on, spiking inflation. In fact, may slow the economy. Yeah. And I wonder if that is why this has changed a little bit. He's still in the same ballpark, but not as dramatic on the outskirts. In other words, we're not as, that things have risen. Now it's a little more tepid, right?
Yeah.
Do you think maybe that conversation changed him a little bit?
It might have, but think about this, Nicole. When they had tariffs in Trump's first administration, inflation didn't go up. They went down. And a lot of that rhetoric was the same, that it was going to increase prices. It was going to drain down to the consumer. Well, maybe prices have increased a little bit, but the consumers pulled back on their consumption a little bit, right? While wages remain steady at 3.9% gains year over year. So the consumer's making this easy as far as the inflation side of their mandate. Now, we got the dot plots out, and a lot of people were curious to see if they were going to go from that 50 basis points of cuts for 2025, which they stated in March, the last time they gave the dot plot readings. it's still at about 50 basis points. 7 Fed officials see no rate cuts at all in 2025. 2 see 1 cut, 8 see 2 cuts, and 2 of them see 3 cuts. So it's across the board as far as economic projections from some of these voters at this point. But yeah, it's pretty surprising that we're not seeing the expectations that we're only going to get 1 cut, because a lot of people out there, Nicole, are saying that we're not going to get any cuts at this point. But if we see that trend of inflation continue and potentially that job market continue to show little bits of cracking here, where maybe we get that unemployment rate to 4.4, 4.5%, then the Fed's going to have to react to that. I think that's going to be the key, maybe from some of the Q&A that we're going to have with Fed Chair Powell in about 25 minutes.
Okay. That was a great summation, and I like that about how many of the Federal Open Market Committee members were voting. 7 said no cut.
Yeah.
That's a good amount. That's almost as many that said 2 cuts. It's very interesting. Okay, well, the conversation continues. Tom White, great to see you.